Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month nickel. The break higher during Christmas week up over the gold long moving average, which is currently at 16,010, as well as over the key levels at 15,665 and 15,840, saw a significant release of bullish energy that had been pent up for about 2 years. This led to a complex coincidence of patterns over January of a quad top with individual pipe and horn tops in there, and the main pattern being a January-based ascending wedge pattern. The break lower from this pattern happened late January and gave a primary downside target in the 17,400 zone, which was reached the same day, but a much harder to reach secondary target down in the 16,075 zone, which I have since retired as being no longer viable. What caused this change of view was the move we saw from the ascending wedge pattern straight into another similar setup. Originally it was a bright red February-based possible ascending triangle or ascending wedge pattern that has morphed into what we now have, a shallow bright red bull channel, currently 17,135 to 18,425. I originally thought this might be part of a large late January-based bearish halfway hesitation pattern, potential down as far as the 15,750 zone. And we did have an attempt to trigger such a pattern in mid-March when I set the trigger point as the 50% Fibonacci line of the 2025 to 2026 move at 16,515. But all moves lower failed. I even looked at the action over February and March as a nascent bearish cat's ears pattern, but these all came to nothing. And instead, February and March and now into April have made two significant patterns. The first, and the more dominant now, is the shallow highlighted bright red bull channel, currently 17,135 to 18,425. There is nothing I can add to this one as it is simply the dominant pattern right now. The second pattern is a little more obtuse but still there as a pattern, and yesterday we broke higher from it. It is the late February to mid-April dark blue descending expanding wedge pattern. This one has had the required number of touches, and with the significant break higher yesterday, I have decided to lay out some targets for the move higher. Some somewhat optimistic, but given the circumstances still valid, though I say I have my doubts about it. Thus the primary target X is up in the 18,835 area, close to the August 2019 high at 18,850. And a secondary, harder to reach target X1 up in the 19,135 area, close to the highs of this year. The cause of this latest move higher can easily be seen as last week and this prices have been squeezed in between the dark blue upper trend line overhead, helped by the declining short medium moving average, which is currently at 17,415, and from below by the rising bright red lower bull channel line. Thus, it was not a surprise that we saw such a move yesterday, as something had to give way, and it seems the dark blue upper trend line and green short medium moving average have been tagged it. LME 3-month zinc. The market has cleared up a number of patterns affecting the market in recent times, all happening at the same time. The most significant of these past patterns had been the one that emerged 10 weeks ago, a mid-December 25 to March 26 imperfect, quite steep bull channel. 5 weeks ago we broke down through the lower bull channel line and the market exploited the move lower. I had previously laid out targets for such a break lower of a primary target X down in the 31.89 zone and a secondary harder to reach target X1 down in the 31.29 zone. These were both reached in the same week, 4 weeks ago. Now there's also another pattern which I spoke about 3 weeks ago, and I quote, "There is another pattern to consider, and it's one that has taken its own sweet time in growing. It is a possible late January to date triple top pattern. This derived from the earlier lopsided double top, though some might still see it as a lopsided head and shoulders pattern, and I could see their point, as a head and shoulders top is a derivation of a triple top, but I tend to favour the triple top idea overall. For this one, well, despite the activity, it still hasn't been triggered. As I said 2 weeks ago, so that is now actually 5 weeks ago. As I said 2 weeks ago, I would look for confirmed consecutive closes under at least the 3240 level to even start talking about potentials and targets below. So far this has not happened, though it may happen this week, and so it is right that I make you aware of it as a potential bearish pattern idea. End of quote. Well, the market has also reached all the targets on the downside for this pattern as well. So what has this left us with? Well, it has left us with just one pattern, and it's a big one. One I spoke about before. It's the bright red May 23 to April 25 bullish Andrews pitchfork, and especially the middle time, which is currently at 34.11, that is just above the current market, and which may be causing the hesitation we saw in moving higher last week and this week as well. Now, I should also note that we have mixing in right now with the market two 50% Fibonacci lines of the March 20 to March 22 move at 33.29 and 50% Fibonacci line of the April 22 to May 23 move at 33.77. These two 50% Fibonacci lines should also not be underestimated. LME 3-month tin. There have been multiple recent big patterns that have been in part created by a super large pattern. The big patterns have been the January and early February head and shoulders top, one that looked like a head and shoulders top that formed only one part, the first part of a really massive double top pattern, which within the depths of the valley between the double top saw the creation of a double bottom. Now, I said on the big double top pattern 3 weeks ago, and I quote, the key level to look for is confirmed consecutive closes under the 50% Fibonacci line, the April 25 to January 26 move at 43.985. And though we have come down a lot, we still haven't come down that far. End of quote. Well, in mid to late March, the market tried pushing lower, closing below the trigger level of the 50% Fibonacci line, but failing and seeing prices rise back up. This was due to one definite reason and another possible one. The definite reason was the bright red middle time, currently at 41.075, of the one big old pattern, still even now dominating this market. The bright red, shallow, big old 2020 to 2022 bullish shift pitchfork. A pitchfork that is still in operation 4 years old after it was created. The secondary pattern was just below this one, the slowly rising long moving average, the middle time that is. The slowly rising long moving average currently at 44.85. In truth, I think the bright red middle time caused a halt to the decline, just as the bright red upper time, currently at 58.495, managed to cap the highs of the big double top back in January and February. Since that halt and the move down in March, price has created a small dark blue ascending wedge pattern over mid-March to early April, breaking out of the lower dark blue trend line into, I suspect, prompted by that break by the green declining short medium moving average, which is currently at 48.510. However, a greater moving average from below propelled prices higher over the last 2 weeks, and that's the rising mauve medium moving average, currently 46.210. Today we are above the green short medium moving average. So, what do we have in the way topside? Well, I would look closely at the 2022 high at 51.005. This may not look that great as a congestion at first glance, but it was instrumental in making the center of the double bottom in mid-February, and I would not ignore it. However, we also have some Fibonacci levels for the whole of 2026 move at 47.595, 49.775 and 51.960. The most important of these is capping the market today, and that's the 50% Fibonacci line at 49.775. Beyond these, there is limited resistances even, until we once again start looking at the bright red upper time once more.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.